You've done it before. Everyone has. You see a stock, a coin, a stock, a house price, something going up, up, up. Everyone around you is talking about it. Your coworker made money. Your cousin made money. So you buy in, and within weeks it crashes. And somehow, without fail, you bought right at the very top. This isn't bad luck. It isn't a coincidence. There is a specific psychological mechanism hardwired into your brain that makes you do this over and over again. Today we're breaking down exactly what FOMO is, why your brain is basically built to fall for it, and, more importantly, how you can spot it happening to you before it's too late. FOMO stands for fear of missing out. It sounds simple, almost silly when you say it out loud. But in financial markets, FOMO is one of the most expensive emotions a human being can feel. Here's the technical version. FOMO is the anxious feeling that other people are experiencing rewarding events while you are absent from them. In investing, that translates to other people are getting rich and you are not. That feeling doesn't stay abstract for long. It turns into action. And that action is almost always the same. You buy. Not because you did research, not because the price is a good value, but because the pain of missing out becomes stronger than the fear of losing money. That's the trap. FOMO doesn't just cloud your judgment, it inverts it. Fear of loss, which is supposed to protect you, gets overridden by fear of missing a gain. To understand why this happens to literally everyone, including professional traders, you have to understand a bit about how the brain evolved. For most of human history, missing out was actually dangerous. If your tribe found a food source and you weren't there, you might starve. If everyone ran from a predator and you hesitated, you could die. Our brains developed a strong social following instinct. When the group moves, you move with it. Hesitation was often fatal. Fast forward to today. That same ancient wiring is now applied to candlestick charts on your phone. When you see a price going up rapidly, and you see other people around you, online, in your group chat, on the news, getting excited and profiting, your brain doesn't process this as market data. It processes it as a survival signal. The tribe is running towards something good, and you are being left behind. At the same time, dopamine, the brain's reward anticipation chemical, spikes not when you actually gain something, but when you anticipate a reward. Just watching other people win activates that same anticipation circuitry in you. You don't need to have made a single dollar to feel the rush. You just need to watch someone else make it. This is why FOMO buying rarely feels like a rational decision in the moment. It feels like relief, like finally joining in. That's your brain rewarding you for doing something that, statistically, is about to hurt you. Here's the part that should genuinely unsettle you. FOMO-driven buying follows an almost identical pattern every single cycle in every single asset class. It starts with disbelief. A small group of early buyers notice something undervalued. Nobody else cares yet. Then comes optimism. Prices tick up steadily. A few more people notice. Then belief. Media coverage starts. Friends start mentioning it. The price is now rising faster. Then euphoria. This is the dangerous zone. Prices are rising in almost vertical lines. Everyone you know seems to be talking about it. People who have never invested in their life suddenly have opinions on candlestick patterns. Taxi drivers, hairdressers, your uncle at a family dinner. They're all in. And that, the euphoria stage, is almost always exactly when the asset is at its most overvalued, most crowded, and most fragile point. It's the stage where the smart, early money is quietly starting to sell into the excitement you're feeling. Then comes the crash, and the last group of people to buy, the ones buying because everyone else seemed to be winning, are the ones left holding the losses. This isn't a one-time historical accident. This exact cycle has repeated across dot-com stocks, housing markets, individual meme stocks, and multiple crypto cycles. Different assets, same human behavior, same result. A common myth is that FOMO only affects dumb or inexperienced investors. That's false and dangerous to believe because it makes smart, educated people underestimate their own risk. A few specific biases combine to make this nearly universal. Social proof. We use other people's behavior as a shortcut for what's correct, especially under uncertainty. If enough people are doing something, our brain assumes it must be reasonable, even if no one has actually verified that assumption. Loss aversion, flipped. Normally, loss aversion protects you. The pain of losing money is felt more strongly than the pleasure of gaining the same amount, so you tend to play it safe. But during a FOMO event, the loss your brain fixates on isn't a loss of money. It's the loss of a missed opportunity. Suddenly, you're loss averse about not buying. The narrative fallacy. Once a price is rising, a story appears to explain it. This is the future. This changes everything. They're not making any more of this. Stories are far more persuasive than statistics, and rising prices make almost any story sound plausible in the moment. Combine these three, and you get intelligent, careful people abandoning their own rules, because the pressure isn't coming from bad math. It's coming from social and emotional signals that bypass logical analysis entirely. You don't need to look far to see this play out. Rapid retail-driven rallies in individual stocks, sudden surges in specific cryptocurrencies, and localized housing bubbles all show the same signature. A slow climb, a media-driven acceleration, a euphoric spike marked by extremely high trading volume and mainstream attention, and then a sharp reversal. The specific asset changes every cycle. 10 years ago, it might have been a certain tech stock. More recently, it's been particular cryptocurrencies or meme assets. In 20 years, it'll be something we haven't even invented yet. But notice, the pattern doesn't change. Only the name of the asset changes. That's the part worth remembering far more than any specific example. FOMO isn't about the asset. It's about the crowd. Wherever a large crowd rushes in quickly, driven by social pressure rather than analysis, this pattern tends to follow. So how do you actually defend yourself against a bias that's built into your own brain? You can't delete FOMO, but you can build systems that catch it before it costs you money. First, set your buy criteria before you feel excited, not after. Decide your entry rules, your price targets, your risk tolerance while you're calm. If an opportunity requires you to abandon your own plan to catch it, that urgency is itself a warning sign, not a reason to act faster. Second, track how you feel, not just what the price is doing. If you notice a specific physical sense of urgency, a tightness, a rush, a buy now or regret it forever feeling, that emotional intensity is a signal to slow down, not speed up. Rational decisions rarely feel euphoric. Third, ask a simple question. Would I buy this if no one else was talking about it? If your interest is coming from the asset's fundamentals, that answer is yes. If your interest is coming from other people's excitement, the honest answer is usually no. Fourth, build in a mandatory waiting period. Something as simple as a 24-hour rule before making any purchase driven by sudden excitement filters out an enormous percentage of FOMO-driven mistakes because it separates the initial emotional spike from the actual decision. None of this eliminates risk. Investing always carries risk, but these steps shift your decisions from being driven by the crowd's emotions to being driven by your own plan. The uncomfortable truth is this: FOMO isn't a flaw in a few unlucky investors. It's a feature of the human brain, and it activates in nearly everyone under the right conditions. The people who avoid the worst of it aren't the ones who feel no fear of missing out. They're the ones who recognize the feeling for what it is and have already decided in advance what they're going to do about it. Next time you feel that pull, that everyone's making money except me feeling. Pause. Ask yourself if you're looking at an opportunity or just looking at a crowd. If this helped you understand your own decision making a little better, subscribe. This channel breaks down the psychology behind money, markets, and the mistakes that quietly cost people the most. And let me know in the comments, have you ever bought right at the top? You're definitely not alone.